this is a great beat, and what Mark and Phil have done really well is explain, like, way up here what's happening: securitization, Wall Street, central banks in China. Right? Okay. So this, and so my mom is like, what? Her eyes glaze over. She doesn't read this stuff. Like, she doesn't care, but she does care. She just doesn't know it. All right, so that's what makes this a really good story. So let's start here and tell me if I'm getting too basic. This is what's happening, but let's start way down here at the other end of the spectrum, and that's you and me and people who buy houses and people who rent apartments and even people who are, you could even argue like homeless people are involved in this debate, because shelter at every level is funded, somehow touched really by the federal government. And this system up here, it touches everyone down here. So you've got a great sort of hierarchy of stories and sources on this beat. So we've got the fun stuff I listed in the challenge. So let's go to the fun stuff with the real people. What I'm trying to do is just give you ideas, and also, just these are, I did this last night, it's really slapdash, but just to give you an idea of people engaged in this debate, okay? We are, okay? People who want to buy a house are involved. Renters are involved. Fannie and Freddie don't just issue securities for houses, they also issue securities for apartment buildings, okay? So it's not as simple as like the single family house on the cul-de-sac that's being affected here. It's a civil rights story, because, and social justice story. Everyone needs shelter. Housing is the biggest form of, and the most accessible form of wealth accumulation in this country, or has been. And so you have a lot of underserved communities involved in this, minority groups, lower income groups. All of these people have a huge stake in this fight because it affects them. Blacks took the biggest hit from the housing collapse in terms of dollars and percentage of wealth lost, because a lot of their communities were targeted by these subprime lending, and so they took a bigger hit than any other group. So this is serious. This is a social justice and civil rights story too, not just Wall Street. Consumer protection, obviously that's kind of obvious. Mortgages are the biggest. It's the biggest debt most people will ever have, and people don't understand it. People don't understand how the system works. Even after the collapse, people really, look at us, we're sitting here like, oh my God. We still really, most Americans still don't really understand how the system works. And consumer protection in this scenario is a big deal. Milken is here in part because financial literacy is such an important issue in this day and age, and mortgages are really a really huge part of that, right? Okay, so that's the real people. Then you have potentially even a more influential group of people, the people who make money off the real people. So the next page. Start with your real estate agent, the brokers. These people are hugely influential, not just because of their numbers, but also because they are highly involved in local politics. So think about where housing and mortgages fit in your community. Your taxes come from, your tax revenue comes from housing. Incomes are made by people who do business in housing, the real estate agents, the lenders, the appraisers, all of these groups. And these guys are hugely embedded into local politics. Why? Because tax rates are based on home values in most places. Okay, zoning affects housing. So it's sort of the real estate empire at this local level that influence trickles up. Okay, so when we're talking about Wall Street up here, you've got your realtor and your settlement lawyer in Minnetonka saying, well, wait a minute, if interest rates go up by 50 basis points, I'm not going to get as many closings. That's a big deal for me. And then you've got, the builders saying, well, wait a minute, if there's no affordable housing, why should I build that apartment building? Okay, so this is, somebody said, where's the rub? Here's the rub. All of these little granular things in the system get affected by what happens here and how we get to this reform. So this is a really fun story. So you have that level. Next, local and state governments, kind of talked about that already. Again, a highly influential bunch of people. Why? Because they all call their congressman when something goes wrong. We haven't talked much about the foreclosure collapse, but let's look at the system. Local governments need property taxes to function. Local and state judges handle foreclosures in most states. We talked about judicial states. Why does that matter in the context of mortgage reform? Well, some states, as we've talked about, have judicial foreclosure systems, which means the courts decide whether or not you get foreclosed on. At the end of the day, a judge says, it's taking longer for those houses to get through those loans to get through the system. Ed DeMarco he's not done anything, but the regulator has said, well, gosh, Fannie Mae, when it guarantees a loan, it charges the same G fee in Florida, which is a judicial state, as it does in Virginia. But wait, the risk to us, the risk to Fannie is actually higher in Florida because it's a judicial state, judicial foreclosure state. So shouldn't I be charging more to guarantee loans in Florida than I do in Virginia? Well, wait a minute. The Florida delegation says, wait a minute, why is Fannie Mae giving Virginia home buyers a better deal than Florida home buyers? Oh, huge political. Okay, so this is why this stuff down here is really important, getting into this debate. Somebody mentioned housing finance agencies. Small piece of the securitization puzzle, big piece of the political puzzle. Between the state governments, realtors, builders, unions that work for builders, settlement companies, which you've never heard of. Probably nobody can name a settlement company. Mortgage insurers, again, who? Never heard of these companies. They're massive. These are all the people that do the business down here. All of them have a stake. Combined, they're unstoppable. Politically unstoppable. So just think about that when you're looking for stories, etc. So I've already kind of gone to the next slide. Wall Street, commercial banks. We've talked about private label securitized issuers, which are the ones that were doing the subprime lending. Mortgage insurers. What are they? This is a whole group of people we haven't even talked about yet. These are big financial services companies that say, we'll take a piece of the risk of this loan. They kind of sort of do what Fannie and Freddie do, only without the government's help. That's kind of shorthanding it. But these guys have big money in the game. And they're insurers. They're regulated by the states. Okay, so, again, it's not just happening up here. It's happening way down here. And there's this huge hierarchy. Investors. What's an investor? A bondholder. Who are bondholders? Me. Okay, my 401k has mortgage-backed securities in it. Every pension fund has mortgage-backed securities in it. All the central banks have mortgage-backed securities. Right, so the investors, I don't think it was you, somebody said, corporate bondholders are people too. It was like a great quote, right? So everything that happens up here affects all of the people on this hierarchy. So you've got endless potential for stories here as this starts to move through. And then, of course, the top of the heap. Yeah.
Question about mortgage insurance.
Yeah.
Just as again, looking at real people who are buying houses, typically, if you are putting a smaller than 20% down on your house, you have to buy mortgage insurance. Whose rule is that?
That's Fannie and Freddie rule. So a rule basically written by the U.S. government. And
So
it was
is
one
that
way.
likely to change under any of these
That's
scenarios?
that's one of the questions. How does that change? But yeah, this was one thing Fannie and Freddie did to offset risk, right? So I want to buy a house. You don't have 20% down. We're going to charge you a little extra because we can't afford to take the risk of giving you more than an 80% loan. Okay, so who takes on that risk? The mortgage insurers. What's a mortgage insurer? Genworth? Genworth is a big one. There's a new mortgage insurer in town, a couple years old. Essent. Has anybody ever heard of that? It's owned by Goldman Sachs, JP Morgan, I don't know who else, somebody else big. They just entered the market seeing that, oh, reform's happening. Mortgage insurers are going to be in the mix because somebody private, not the government, is going to have to take on some risk. Yeah, us. And we can make money doing this. So a new entrant to this obscure market backed by these giant Wall Street companies. Okay, so like, all right.
So when you say that it's up for discussion on that 20%, you mean going higher or lower?
I don't know, right? That's like where, there's the rub, okay?
The mortgage insurance is under reforms.
I'm sorry?
You're talking about mortgage insurance will happen under the reform system, these private.
They'll be part of the system. It's in
We
some,
don't have that now.
we
right?
do. So when you, okay, so when, the rule of thumb, I want to buy a house, well, you have to put 20% down. Well, we all know that's not really true, right? But if you don't put 20% down, your mortgage payment is a little bit higher. And one reason it's higher is because you have to pay the mortgage insurer because he's going to take on a little bit of the risk of me giving you that loan because you haven't given me 20%. So I'm a little uneasy. So I'm going to insure some of that risk and charge you for that, what it costs me to insure it.
Is this because it's called a non-conforming mortgage or not?
No, that's different. Okay, so, all right, a conforming loan is a loan that fits all of Fannie and Freddie's rules. Fannie and Freddie, there's something called desktop underwriter. It's literally like a software system with blanks, and you put in the numbers. Joe makes $100,000 a year. He wants to buy a $500,000 house. He only has $50,000 to put down. You put the numbers in. Wait a minute. Fannie's computer system says, nope, we need 20%, and his income's not high enough. And gosh, that house is in Minnetonka. No way, right? And so the computer spits the numbers back out. It's non-conforming, right? So there's room for maneuvering. Okay, let's say it's in New Jersey, right? It's $1 million house. Well, we're definitely not touching that. That's non-conforming because it's too big. It's a jumbo. It's too much money. We only go up to 600 something. So that's a conforming loan is one that fits perfectly into the box of Fannie and Freddie.
So it's not just the income level. It's not just the value of the $600,000.
It's also how much money you make. It's how much money you can put down.
So if you're not jumbo, and you're not conforming, and you're not subprime because you have really good credit, what are you?
Well, you're either, Alt-A, yeah.
Sometimes Alt-A is
It's a
something that's
shorthand.
not subprime. It's not a bad mortgage per se, but it doesn't fit the standards of Fannie and Freddie.
And look, this is where innovation is actually really important, and it's a big policy question as we go down this path, right? Not all exotic loans, Alt-A loans, are bad, all right? Like ARMs, everybody freaked out about ARMs. Really, in most of the world, like the ARM is
Adjustable
basically
rate mortgage.
is how mortgage functions, adjustable rate mortgage. You have an ARM, a mortgage where you pay the same interest rate for like 10 years, and then it starts moving. That's because other countries don't have Fannie Mae and Freddie Mac to control interest rate risk. Okay, so you limit. Most mortgages are paid off within like 7 years is the rule of thumb. A mortgage basically lasts for 7 years. And so other countries have said, because you either refinance it or you move, buy a different house, whatever reason, okay, you only own that mortgage usually for 7 years, rule of thumb. Other countries like know this, and so they say, okay, we'll put a little buffer on here. We'll say 10 years. We'll give you 10 years of the same interest rate, and then it starts moving because they know 99% of people aren't going to have their loan for that long anyway. Okay? So, ARMs. Not bad. Okay, but that's Alt A. So, but we need, innovation is like not a, some of these loans, like 1-year ARMs, I actually had a 1-year ARM. I had a really good reason to do it. It was the right thing to do. It was really smart. I was able to get it. That's crazy. No, it wasn't. It was actually, I knew what I was doing. But this is where the financial literacy comes in, right? Most people don't get that. These things serve a purpose. They're not all bad. What else? Okay, so I'm just going to show you this page. Go to the challenge. Linda made me do this. I was up all night.
Thank you for doing it.
Okay, Mark took a look at it. He said it was right. So, but, always check. But this is
This is the kind of thing that you probably don't need to memorize, but the next time you're writing a story that deals with these issues, you're going to have a cheat sheet, and you're going to thank me.
okay. This is just, there's a lot of acronyms, more than I've ever seen in any beat I've ever covered. And most of them you really don't need to know, really. Most of them you will never write about. TBA, all that is a way for basically the bond traders to trade bonds that don't exist yet, haven't been issued yet. And that is a service that Fannie Mae and Freddie Mae and Ginnie Mae actually provide to the economy and to the markets. Do we still want that in the new system? I don't know.
What's the OMG?
Oh my God. Oh my God.
Yeah, I don't see a definition here next to that.
Yeah, it just means oh my God. Yeah. Exclamation point. All right.
So did you have other specific things you
No,
wanted to
no, I just kind of listed some questions on the back, but
I would love to have, just for a couple of minutes, does anybody have sort of examples of great down-to-earth stories that you've written about housing or housing finance that have kind of gotten to the real people? Now, I'll give you one example from years ago at the height of the bubble when I was editing stories that dealt with the fastest growing, at that time, the fastest growing city in the United States by percentage, which was Pembroke Pines, Florida. And we went out and did a great story about all the people who were living in these gorgeous McMansions way out in the suburbs, beautiful homes. And you walk inside and there's not a stick of furniture because they'd all bought homes they couldn't really afford. And these were the ones that ended up in those securitized
great.
packages. But it was a great story because it illustrated the bubble before everybody even knew there was a bubble. It said, there's a problem in Pembroke Pines, and here it is, and it's illustrated by all these empty houses.
Yeah, and that's actually, this is all really transparent. Every house transaction, it's all public record, and most of it's online now. If you go to your local city, township, you can get this stuff. And it will also tell you what that house sold for, and you can, I think in most, not all places, you can also see what the loan is, the debt is on that property. All right, so usually, I used to do title work in college, right? You can go pull up the deed to the house, and then at the very next document, you can see how much they had to borrow to buy that house. So Wall Street Journal did a really incredible story right when all this was happening. They took these these bonds, and you can go into this, on Bloomberg, I can go in, pull up the bond, and I can see every single property, every single mortgage, and the address that's in that bond. And that's what these short sellers did before the collapse, and that's how they made money. They went in and they looked at every single address. And they said, wait a minute, there's a mortgage on this house at this address for this amount?
Right.
Are you
This is
crazy? Like, what? We're not stupid. And they shorted it.
I have a question about covering, not a policy story, but more of an economic story about housing. If you're trying to evaluate the recovery in a local market or how housing is doing, there's a wealth of statistics out there. It's just mind-numbing. What are the key ones that somebody should look at if they're trying to evaluate how well a city is doing in recovery?
Well, I mean, I think the economists look at Case-Shiller.
Home prices?
Yeah, on home prices. Case-Shiller has gone in and they built this new index that looks at it's very hard to measure home prices because everything is localized. Like there's no sort of centralized place to measure every single home transaction.
No, I'm talking about a local market.
But locally, yeah. The thing is, so like Case-Shiller does some cities.
Case-Shiller tries to adjust for changes in quality, right?
Yeah.
You know, if there's 20 sales this year and 20 sales next year, we know they're not going to be the same houses, and people look at the median to try to, reduce the influence of super expensive or super low priced homes in an area. But Case-Shiller tries to do more by trying to adjust for the differences in houses that are sold from one year to another, and that's
Right.
what the Case-Shiller index does well over other
Yeah,
indices.
right. Like the realtors maybe have the most comprehensive collection of numbers because they record presumably every or most transaction, but they can't always be trusted. They have an agenda, which is we want homes to sell because otherwise we don't make money. That's fine, but they don't always adjust for higher priced homes, et cetera. Like so what Case-Shiller tries to do. You can usually find an academic in your
Well, I'm
neighborhood.
not interested in sources so much as what data. Is foreclosure rates or home prices? Which is more important?
So the foreclosure rates will have an impact on home prices, right? So this is one thing that's been holding down home prices over the last 6 years is the number of foreclosed homes, which puts downward pressure on home prices because these kind of forced sales, like foreclosure sales, put downward pressure on home prices. So I would look at prices first, but then look at foreclosure rates as a signal of downward pressure on prices.
You might also look at underwater mortgages, percentages of
Yep.
mortgages underwater in an area.
Which is like future foreclosures in a
Yeah,
sense.
exactly,
People
yeah.
people who might turn into foreclosures.
Zillow has a
Zillow
pretty
is a
good
source of
data.
Yeah, that's right.
But they're using their own data, right? Zillow.
Yeah, Zillow is-
Zillow's using their own data. I would.
They do a good job of adjusting also.
Okay.
That's why they Trulia,
Okay.
Trulia and Zillow. It's interesting. They've both hired very good economists to do some of these adjustments. To kind of following the Case-Shiller approach to say, we've got this really rich data. Let's try to do sensible adjustments to it.
And they're really accessible, both of their economists.
Yeah, Jed Kolko is the one I know. He's great.
Trulia.
Yeah, he's at
Yeah.
Trulia. Okay,
Yeah.
he's great.
Right.
Yeah.
You might also consider looking, because I come from public finance, I'm accustomed to looking at the city budgets and the city financials, so you might want to look at sort of property taxes, how they're trending, collection rate, as well as how they relate to home values.
I did a story. This was years before the housing collapse. I covered Fairfax County, Virginia, and they were doing their budget, and they were trying to figure out how much to raise property tax. Annual debate, normal. And they said, well, home prices in the county have gone up X percent, and so we think we can raise, the property tax by like Y percent, a few pennies. Everyone started coming out to hearings and calling us and saying, well, wait a minute, my home value has gone up this much, and my taxes have gone up this much, and so your estimate of how much home prices have gone up in the county is way off. And so I actually got a bunch of reporters. We picked I don't know how many addresses, and then we called the tax assessor on every address and got the value of the property and the rise in value. And the county's estimate was way off, completely wrong. And at the end of the day, they had gotten too many commercial properties into their estimate and some other things. And so they, at the end of the day, didn't increase the tax rate as much as they had proposed. So your tax assessor is a good, source.
I love this idea of looking at the rate of uncollected taxes, because that says something about the economic health of the city.
What's confusing still?
Well, I mean, there's just so many numbers out there, and there's housing starts, single-family permits. You know, I guess I'm looking for maybe one or two key numbers to key in on,
Well,
to keep track of.
I mean, starts are, and permits are both leading indicators, like they give you an idea of what's gonna be happening, we think. So that's one reason people look at those. But that's such a small piece of the market overall, new homes, that you're better off, I think, in terms of looking at your local economy or the local market, I think you're better off looking at the other
Wasn't the key
indicators.
data that foresaw the housing bust, default rates?
Mm-hmm.
They began to inch up in 2006, and
Yeah.
that was the signal, something was gonna happen.
And
That's
it's default, and it's also loans that defaulted very quickly, that people, within a month or two,
Right.
People defaulted. That was like that.
Remember what I said about a loan lasting 7 years, basically? Usually they say within, I think it's 3 years, it's matured. So if it hasn't defaulted in 3 years, the rule of thumb is it's not going to default.
Yeah,
That
absence-
rule was proved wrong.
Well, absence that sort of
Proved
dr-
wrong in a
drugs,
big way.
Rock and roll, sort of.
Yeah, right.
Some people go to prison or whatever.
Yeah, right. Yeah, right. So that rule started like going awry, and that was what you're talking about. Yeah.
And one thing is probably obvious that, a loan doesn't default. Mortgage generally doesn't default unless it's underwater, right? Because if your mortgage is above water, you don't default. You sell your home, right? And you get maybe you get a little equity out, whatever, but you don't default, right? So it's a combination of, home prices and, and income. I lost my job. I can't afford my house, but I'm not going to default on it as long as I
just
have
sell
some
it.
equity, and I just sell it.
Yeah.
Yeah. So, but that's what
But
that
you
is.
can't do
Is
that
the
when
data
home
around
Right.
values have.
Right.
No, exactly, and that's
Right,
exactly,
that was
and
the
that's
problem.
that's what happens. That's why you get defaults. Then.
Is there data on late payments, like 2 months in arrears, 3 months?
Yeah.
Yeah, there is. Yeah.
Mortgage bankers definitely track that.
Yeah, mortgage bankers is
Mhm.
great on that.
The Federal Reserve tracks like how much in aggregate people are borrowing.
Here's where I was confused on the mortgage insurance, because at one point I thought I was hearing that Fannie Mae, Freddie Mac, they back 100% guarantee mortgages. They guarantee the mortgages, so people who hold the mortgages aren't gonna lose
So
when people default. So I took that as they're insuring the mortgages. But then you say private insurers offer mortgage insurance.
So yeah, the problem is there's so many types of insurance, going around. Okay, so let's talk about the Fannie Mae, Freddie Mac, FHA, basically insurance. That's protecting the bondholders, saying, so I buy a bond of mortgages, I expect to be paid this many dollars every month from that bond. I expect this much money to come in every month. But wait, suddenly 30% of the loans, I'm just making this up, in that bond go bad. The money's not coming in. Oh, it is, because Fannie Mae and Freddie Mac have guaranteed that I'm going to still keep getting that money every month, no matter how many mortgages fail in my bond. So that's an insurance that Fannie Mae, Freddie Mac, and FHA,
Which we call the guarantee.
the guarantee. And that's what the bondholder in this whole meltdown, the one group that came out completely whole, were the bondholders, except for the private label. But okay, so that's one type of insurance. Then you have Fannie Mae and Freddie Mac. Well, we'll give you a loan if you only have 10% to put down. Technically, it's conforming, but it's like, okay, but we're going to charge you more for it because we think there's a higher risk that it's going to go bad, and so we're going to charge you mortgage insurance, and that protects Fannie and Freddie if you stop paying. Because if you stop
Sort of
paying,
like a gambler laying off part of a
yeah,
bet.
Yeah.
It's they're buying separate insurance to cover their potential
So they're
losses.
reducing some of their risks.
Their
Some of
risks.
that guarantee that they offer to
Right.
the bondholders, they're reducing them. So by charging some mortgagees insurance.
right, and those mortgage insurers a lot of them like are having serious problems still. Serious problems. And they are big companies. But they've been able to manage this because they're regulated by the states, and there's like things they can do to kind of push off the bad, failed bets, bad insurance, and then they sort of reconstitute themselves with the good stuff and kind of start over. But those guys are still, and they're big. And then you have title insurance, which means that I sell you a house, free, you know, I sell it to you, I guarantee I'm selling you this house, it's all good, it's yours, and then 3 days later, somebody knocks on the door and says, that guy didn't have the right to sell you the house. That's my house. You've insured yourself against that when you buy your house, and your mortgage banker makes you buy that insurance. Just to complicate things.
When we started this, we was told that the United States is somewhat unique, our system, right? The 30-year mortgage, for example, is not universal around the world. Probably one of the few. Denmark, how do our housing statistics stack up in terms of home ownership?
Yeah, where are we now? Are we
About
still
the same. I mean, we're basically back where we were, like in the 80s. Yeah, I mean, so home ownership rates in other countries are pretty similar to the U.S.
Home owner rate?
Yeah, home ownership rates. Yeah,
Even though they have
different systems. Yeah.
All right, a final question.
It's kind of like out of school, but just respond to his question. I came from Saudi Arabia, and I'm just wondering, like, everybody I know in Saudi Arabia, they buy their house by cash, or they, like, maybe if they don't have it, they borrow from a dad or uncle or whatever. The people who don't really have money or cash, they rent until they like get the amount of money to buy a house, and then they buy it. So I was wondering, what's the difference, like that difference from Saudi Arabia and here? Since I see like we calculate how many interest the bank takes when offering the home mortgage, and I see everybody is having home mortgages. Everybody, even though I'm not asking the people who don't really have somebody to support them, but I'm asking about the wealthy people who still having their home on mortgage, like.
There's a tax.
Even- yeah,
there's a
if
tax.
you're
There's a
deduction.
tax, yeah.
Yeah.
There's a tax benefit to having a mortgage.
Okay.
That's one
but
reason.
there's also an interest, and like a huge like amount of interest involved. So I
Yes,
was wondering
that's
what-
where the tax benefit comes in. Yeah.
Oh, okay.
And there's also, it costs money to buy a house and sell a house. You know,
Oh.
to sell a house, it costs, at the end of the day, it's gonna cost you 8% of whatever your house is worth to sell it. So you take that, but one reason we built this system where we've encouraged people to take loans out to buy their house
Yeah.
is because housing is proven to be a great way for people to get wealthy, all right? Like, because your house increases in value, you can pay your mortgage every month the same as you would pay your rent, except that you're getting an asset that's supposedly going to increase in value, and then when you retire, you will have all this money that you've saved into your house, put into your house. That's kind of the theory, and we made it easier for people to. I can't pay cash for a house, no way, right? Few people can. So do we limit access to that wealth builder only to people who are already rich? Or do we try to get like normal people, get them a foot in the door so they can increase their wealth too? So we've made this mortgage system that allows that. 10% down, 3% down.
They do have like a wealthy mortgages. They don't really, even if they have excess cash, they always prefer to take the mortgage. Maybe because it's.
Well, look, if your mortgage is 4.5%, yeah, I take that mortgage because it's free money.
Yeah.
You can't, you put your $1 million in the bank, you're not going to make 4.5%. You're better off having a mortgage now than a savings account.
You can do something else with that money. And on that, I am going to wrap it up.
Thank
It's
you.
noon. I want to thank everybody for being here.
Oh, can I explain really quick? I printed out 4 stories for you. Some of these are really inside baseball. I did that on purpose. Look, this mortgage bond meeting This is a really inside baseball weedy story, but I gave it to you because it shows you the type of thing that's going on now with all these companies that you've never heard of getting ready for this big fight. So this is sort of a, just so you know, lobbying potential. Mass refi, this is, I tried to draw a line here between a homeowner and the bondholders and how they're basically kind of the same people. That's why I gave you that story. We just put this out.
Oh, yeah.
B of A office stymied needy homeowners. Evidence that the foreclosure mess is still here. It has not been fixed. It's still happening. And then I just gave you sort of an overview of the lobbying sort of landscape, which we've gone through. But that's why I picked those four.
Awesome.
Okay.
Lorraine, thank you
Thanks.
so much.
That was fun.
Lorraine Woellert, everybody.
Thank you so much.
Thank you.